Okay, hello and welcome to episode 6 of the Technical Bootcamp. Today we're talking about equal high and equal low liquidity. So this class is really going to be an introduction to the concept of liquidity. We have a few classes on this topic to go through because it's quite elaborate and there's a fair bit to talk about. But we're starting here with the theory behind liquidity in the market, how to identify equal highs and equal lows, and then how to utilize those equal highs and lows to take better trades in the market. Now we use these equal highs and equal lows to filter opportunities, avoid taking bad trades, and also get better clarity around where the market is likely to be drawn towards. We're going to be deep on theory in this class, talking about why this all happens, okay? I want you to really understand this so that when we get into the actual concepts like equal highs and lows today and other types of liquidity in the next few classes, you fully understand it. So anyways, with that said, let's get into the class. Hope you enjoy it. Sure you will. Let's go. Okay, so liquidity. The next few classes are going to be focused around liquidity in its different forms. We're starting in this first one with equal highs and equal lows, which is the most common form of liquidity that you will see and use in the markets. It's the easiest to identify. It's basically the cornerstone of liquidity-based trading. Now, before we get into what equal highs and lows are and how they operate in the market, we need to spend some time to talk about the actual theory of liquidity and what liquidity is, where it forms, why it forms, and essentially why it happens, okay? So we're gonna do that with this diagram. Just imagine this is a single leg of price action. We've marked the high, we've marked the low, and I'm gonna explain to you now what liquidity is. So liquidity in its simplest form refers to orders or money, okay? So it's buy orders, it's sell orders, it's points where transactions are likely to take place in the market. Now, if we think about what drives the market based on what we've been learning throughout this bootcamp, it's buying and it's selling that creates price appreciation and price depreciation. In order for trades to take place, therefore, in order for any price movements to take place, there must be buying and selling taking place, okay? You have to have buyers, you have to have sellers transacting at different price levels, and that is what creates the upward and downward moves in the market. Now, by that right, it is directly orders that create the price. It's orders that make markets move up and markets move down. Now, liquidity, as we've said, is orders. It's areas in the market, pools in the market where there are significant numbers of buying or selling orders, okay? And why this is relevant and why this is important is because when we identify an area that has significant liquidity or a significant pool of orders, we identify, number one, an area that price is likely to be magnetized towards. Why? Because it's the orders that will make the market react. So until we hit a point of significant orders, the market will just naturally drift. And number two, because when those orders are filled, these are the points where the significant reactions take place, okay? So this is where we start to see big moves coming in instead of just small sideways ranging moves. So liquidity is just money, it's just orders. That can be in the form of stop loss orders, okay? If you are looking at liquidity above this high, for example, above here, you're going to have stop losses. So think about general retail trading education. If you sell a resistance or you sell from a high, where do you put the stop loss? Well, general education suggests you put it above the high. So we know anyone selling inside of this range is generally going to have their stop losses over the high, okay? We will also have above there sell stops. So no, buy stops even. So buy stops are automatic orders that trigger traders into buys if a level is hit. Breakout traders use buy stops because general retail education suggests if a high is broken, you should look for a retest and buy the retest to take the market higher. So we have a lot of traders who use buy stops at these levels to trigger them into a buy automatically when a level like this is hit. So this collection of buy stops, which is going to be in the thousands, and this collection of stop losses, which again is going to be in the thousands, creates a massive amount of liquidity or orders. And these orders act as a magnet for price. Not simply because they are going to pull price in, but because there just simply isn't enough significant buying or selling taking place within the range to create a dramatic move. So the market could easily drift up here, and then eventually when it gets to this point, it will see a massive push of liquidity because loads of new orders are entering the market. And that's what can create these dramatic movements, okay? Whether it's continuations or whether it's reversals. It's why often, if you've ever been in the position where you feel like your stop loss got hunted, that's why it's taking place, okay? Not simply as an attack on you as a retail trader, but because the natural market flow will allow markets to drift towards areas where significant orders are. And only when we hit a point with, thousands of orders at the same level, do we have the money available to kind of transact in huge numbers and create big moves, okay? So above swing highs, the liquidity will be in the form of stop losses and buy stops. Below swing lows, liquidity will be in the form of stop losses and sell stops, okay? So there we have our liquidity on the downside, liquidity on the upside, and both of these, as you can see, are simply just areas where there are lots of orders situated. Now, let's talk a little bit deeper as to what each of these orders actually are, okay? Because this is a point that a lot of people miss. I don't want you to think of liquidity as just this mystical thing. It's very simple. It's actually very logical when you understand how it actually operates. So first off, let's take a look down here at this kind of liquidity pool, we could call it. This area where the stop losses and sell stops are sitting. If we think about what this is, it's basically just a price level, okay? And we have buyers in here deciding that they're going to put their stops under the swing low so that if the market takes out that level, they'll be taken out of the trade for a small loss instead of getting themselves into big trouble. Now, we also know there are sell stop traders, so breakout traders, who have decided they will put their sell stop there, anticipating that if the market does break this level, they'll be triggered into a sell and they can profit from the move down. All right. So those are the two types of traders that we have. But let's think about what these orders actually are for a moment. Because obviously, yes, they are stop losses and yes, they are sell stops. But this is actually just how the order is triggered or the use of the order. If we think about what these are in their most raw form, these are sell orders. They are orders that will automatically sell contracts to the market at this given price. Okay. So if we think about the buyer who bought into the market here, let's say this buyer has paid 1.195, let's call it. That's how much they've paid per unit. So at this point, 1.195 is the euro to US dollar currency rate. If the market goes up, they can sell each unit for 1.21, for example, which is a nice profitable move. But if the market goes down to 1.1915, let's call it, just under this swing low, well then that is the price that they would sell at automatically through their stop loss. They would take a loss on the contracts that they sell. So they'll be selling them for less than they bought them for. And that is where the loss comes from. Okay. So all a stop loss actually is just you sending an alert to the broker that if the market gets to this price, you want to sell all of the contracts that you have. Okay. So if we imagine there are thousands of buyers in here, which generally in a given price move there will be, that means we have thousands of buy orders, which therefore means with the stop losses down here, we have thousands of sell orders. Okay. So there's a significant amount of essentially forced selling orders. It's not people selling out of confidence. It's people trying to escape a losing trade. But every one of these stop losses down here for any buyers is simply a sell order saying, if we get to this price level, I will sell all my contracts back for a loss for less than I paid for them. Sell stops, again, these are more confident sell orders, but these again are just sell orders. So basically down here, we have a massive collection of people saying, when price hits this level, we will all be selling in mass. Okay. Now this, from what you may understand of the markets, should theoretically lead the market to a massive downward move, because obviously we're adding in here loads and loads of selling pressure. Okay. And if we were to go the other way, just to cover it really quickly, you probably get the message now. The stop losses here are buy orders. So people who have short sold contracts inside of this price range, they basically sell contracts now with an obligation to buy them back later. It's a form of trading, short selling. Now, if they have their stop losses up here, well, that simply means all they're doing is sending an alert to the broker to say, if the price gets up to here, please buy back all of the contracts that I've pre-sold for more than I sold them for, therefore creating a loss, okay? But again, that just means all of these up here are buy orders, okay? This is to buy back contracts for more than you sold them for, and this is to sell your contracts for less than you bought them for. So all of these stop losses result in a loss, but these ones up here are buys, and these ones down here are sells, okay? Again, of course, the buy stops, they are more confident, but they are still buy orders. So we have lots of buy orders waiting up here, and we have lots of sell orders waiting down here, right? That's all that we have when we really break it down. We have stop losses and sell stops creating lots of sell pressure, stop losses and buy stops creating lots of buying pressure. All right. So back to the initial story then. If the market comes down to this level and it hits this price point, we should see a rapid acceleration of selling pressure because there are so many people selling at one point. However, here's where this slightly changes, and this is where liquidity gets interesting. So if we have a huge amount of forced selling taking place at one point, this is actually the prime positioning in the market to actually take the other side of the trade if you are a big market participant who wants to do so. So let's say you are an institution Okay, you're an institutional trader and you want to get into this market on the buy side. The problem is, if you are trading with massive sums of money, hundreds of millions of dollars, for example, that you want to get into this market for clients or for whoever it may be, well, for every transaction, there needs to be someone on the other side, right? If you want to buy $100 million worth of an asset, you need the equivalent $100 million worth of selling pressure on the other side of your trade. And inside of a range, at a point of not significant liquidity, there generally isn't going to be that much liquidity available at any given price level, which creates a problem. So let's say you're the institutional trader and you start buying here, but we're in the middle of a range and there isn't any significant open liquidity. You could place a buy and a little bit of your position would be opened here, but due to the supply and demand nature, if you wanted to get the full buy on, well, your buy would indicate demand, which would drive the price up. And then the next buy that you get may be triggered in here. And then whoever's holding the asset that you want to buy from, well, they may charge you more for the next amount. So your next entry may be here. And by the time you've got your entire position open, your average price may end up being somewhere around here. So your average price on this position is significantly worse than where your prime entry was set up to be. Okay. With this, of course, you have worse positioning, you have less profit potential, and you've got worse exposure, you've got bigger risk, there's more downside that you can potentially run through. So if you're an institutional trader, it really isn't prime or optimal for you to get into your trade at any random level. The ideal place for these traders to get into positions is, well, you probably guessed it by now, a point where there is significant opposing orders to the trade that you want to execute. So if we imagine there are a few thousand stop losses and sell stops down at this low, which generally there will be at points of liquidity. Well, if the market just naturally drifted into this price point due to the fact that no one was adding significant buying pressure, right? Now it's not an attack, it's just natural market mechanics. If the market drifts down into here, suddenly when we enter this range, we have now got loads of breakout traders selling contracts into the market with the obligation to buy them back later. And we have loads of buyers being stopped out of their trades. They are, of course, selling their contracts back to the market. So whereas when we were looking at the market buy here, there wasn't really much liquidity or opposing traders to actually execute the trade with, down here, there is a massive amount of selling now taking place. So if you take advantage of that sell liquidity, of those open selling orders, well, you could get a huge position on in this range without really having any staggered positions. What that would create is a situation where the market trades down into the point of liquidity and then has a sharp reaction, a very quick and strong drive to the upside. And now if you're that institutional trader or collection, then you get in here, perfect optimal entry, perfect execution because of the amount of sell orders coming from thousands of retail traders and smaller institutions and commercial banks. And you could take the other side of those trades and just get this primed entry before the market rallies. And of course, if you take up all of the sell liquidity here by putting huge buys into the market, well, now the selling pressure has dried up. These people have lost their trades. Your buy trade just injects a massive amount of demand, absorbs all of these orders, and creates a rally in this direction with that new demand and new strength coming in behind the buys that you've placed, which of course then leads to higher prices, right? So this is how liquidity works in the market. We have these areas where orders are essentially predictable, okay? We know there's going to be lots of stop losses. We know there's going to be sell stops, buy stops around these swing highs and swing lows. Now, by the way, that's what these classes are all about, determining those different points in the market where liquidity pools will be. And then when the market drifts into these regions, it becomes a prime area for institutions, commercial banks, trading firms, hedge funds to acquire large amounts of these assets at the prime point by taking the conflicting side of everyone else's trades. They absorb all of the selling liquidity that enters the market by taking the buy side in massive numbers, and then the market rallies, okay? And for selling opportunities, of course, it works exactly the same way. The market comes up into a swing high. We take out stop losses, sell stops, or it should be buy stops here because we flip the chart. So many buy orders come into the market at one point. You can absorb all of those orders, take the other side, place huge sells, get a perfect prime entry into the market up here. And then, of course, with all of those buys absorbed, the selling pressure on this way down will be incredibly strong, allowing you to take a fast, strong move. All right. So that is how liquidity works. That is how we operate with liquidity. And what you're going to be learning through the next classes is how to actually take advantage of this. In this class, we're going to do that by talking through the most basic form of liquidity, equal highs and equal lows. So we're going to go and do that right now. All right. So the first type of liquidity that we're going to be talking about in today's class is equal highs and equal lows. And we're going to start off by showing you a diagram of how this works, why it happens, and what it looks like. And we're going to focus on equal highs for this, all right? So what we've got on the chart here is basically an imaginary price move, right? We've pushed to the upside and then we've created what looks like a resistance. So to support and resistance traders or anyone who uses these concepts, this would look like a prime selling level. A resistance is simply a level where we have price touching the same, essentially imaginary line more than one time, okay? And after the second tap, every tap from there onwards, you are looking to sell that level. That's generally what resistance is all about. Support, of course, is the other way. You buy every tap after the second tap of an imaginary level. Now, resistance, because it is so commonly known, and I know so many people are in this kind of price action, smart money bubble on YouTube, but trust me, there are still so many people trading these basic concepts. You would not believe it, okay? Not that we have a God complex over here. I know some people do, but basically just because people on YouTube use price action and SMC based stuff does not mean that it's the only thing people are using, right? There is a massive amount of people trading with what we can classify as basic retail, support, resistance, trend lines, all that stuff. All of it is prone to liquidity and all of it creates these predictable conditions for us. Okay, so with a resistance being a level that tens or hundreds of thousands of traders are using as their selling entries, we know there is going to be a massive amount of selling taking place somewhere in this range. Because of this kind of spread out selling, we know that there is going to be a significant number of stop loss orders above the high because that's what general education suggests to do. So we already have lots of stop losses up here. And we know, of course, from what we just explained, there will be breakout traders who are looking for a breakout to continue buying. So there will be buy stop orders up here as well. So this resistance, which is indicated by simply the market creating equal highs in a market, 1, 2, 3, creates, of course, the equal high liquidity we've been talking about, and also creates an area where there's a massive amount of buy orders sitting up here. All right, so we've gathered this much information so far simply by seeing a resistance level or an area of equal highs. Now, with what we now know about liquidity, how it's utilized by large market participants, well, we see that this liquidity, number one, can act as a magnet for price, simply because the liquidity and orders taking place inside of this range won't be big enough to suppress a natural drift up to this level. And number two, as well as acting as a magnet, can act as a significant reversal point because once those equal highs are swept, we will see all of these buy orders released into the market and large participants can take the other side of those trades in the form of sell positions. They can absorb all of the buys by selling massive amounts of contracts into the market against the buy positions that get opened. All right. So essentially they help the new buyers, the people getting stopped out and entering breakout trades, to fulfill their orders by selling huge amounts of contracts to them. This then allows them to be short on a market with that obligation to buy back contracts later. And this massive influx of new selling pressure, as well as the absorption of all the buying pressure, drives the market down into a new low. So that is how equal highs work in a market. Now, I don't know how far along your trading journey you are, but I'm sure at some point you've had these situations where you've set up what looks like a perfect trade, and then the market has just about taken you out of the market before running perfectly towards your target, okay? People see these as stop hunts, liquidations, that's what people call them. Stop loss hunts is a reasonable name. It's not hunting your stop loss to be malicious, but it does feel that way when you've gotten into a trade and then the market's come through, perfectly pierced your stop, and then ran all the way to your target without you. It's a horrible feeling, but it generally happens because of this liquidity. And when you understand it, you can then tailor your trades to essentially be looking to get in here, okay? Now, there are ways to do this. We'll talk about it a little bit later, but this is what we're trying to do with this new liquidity lesson, right? We are looking to position our trades in line with the sweeps we see, rather than being the liquidity for the big players by getting in too soon, okay? So a simple rule while we're here would simply be never sell below equal highs. If you are sitting in an area like this, or anywhere down here, and there are equal highs or a resistance level live in the market above you, do not get into a trade until that level has been swept. When you see the sweep, then is the time to be looking at getting into shorts somewhere around here, because you can then piggyback the high momentum, high liquidity, high pressure movements to the downside. All right. Now, for the case of equal lows, it is, yes, going to be exactly the same. So if we just flip this upside down, in this case, we would have sell orders, because this is a support floor and these would be classified as equal lows. So it's exactly the same, but it's on the buy side. It's the bottom of a downtrend. It's where people are looking to buy. They see exhaustion. They think the market's going to go up. they get in at these levels, but then the market sweeps those stop losses, and then out the back of those stop loss orders builds enough buying pressure to drive the opposite way. Okay, so that's how equal highs and equal lows work. And obviously that's what we want to do, is join them at the prime point instead of getting in prematurely and getting killed by these sweeps. So let's jump over to a real chart and take a look at what this can look like in the market. Just one quick note. What you're learning here about technicals in the bootcamp is necessary, but technicals alone are not sufficient to get you where you want to go. See, most traders don't get stuck because of what they see on the charts. They get stuck because of the habits, risk behavior, decision-making under pressure, and self-sabotage patterns that simply don't show up in technical analysis. It's things behind the scenes. Now, I've made a super quick 15-minute class which I think breaks all of these down in a way you probably haven't seen before and can truly transform the way that you trade. So head to the link in the description after this class, not now. Click the top link and watch that class. Okay, and with that said, let's get back to the bootcamp. All right, so if we're looking at this chart and we're interested in buying, just for example's sake, I'm not going to go into big picture context. We would not want to buy from what some people will traditionally see as a good buying point of this support floor. Okay. Now, the reason we don't want to focus on support is pretty clear by this point. What we do underneath the support floor is create liquidity. So many traders are going to see this line. They'll see this tap, and they will anticipate that the next time the market taps this level, it should lead into further buys because it's created two reactions already. But the truth is, that doesn't really make much logical sense, other than obviously the basic education of imaginary line creates reaction. But when we think about what the imaginary line actually does, it creates liquidity, okay? We've got sell stops and we've got stop losses beneath this level. With those in place, we understand that a likely outcome, rather than reacting on the level, is to take the level out, trade beneath that point, and then create a rally to the upside from there. Okay. Now, if we look to the upside, we've got these two. This is what I classify as relative equal highs. So they are not quite direct, but they do work in the same way. Above this swing high and these relative equal highs, we will create liquidity as well. So this is going to be in the form of buy stops and stop losses. Okay. So what we could do if we were to get up to this point is identify the market for potential reversals and then trade towards the low, because this is going to act as liquidity, a magnet, a target for price, right? These equal lows. And if the market traded beneath, then we could look for a sweep and for the market to trade towards the high, because as well, this is going to act as a magnet for price too. All right. So we're not always going to be confined between two levels. We won't always have equal lows and equal highs at the same point, but drawing the point home, what we're looking for when we see these equal highs and equal lows is number one, these will act as a magnet for price. So whichever one gets hit first is likely to lead into the other as a target. And number two, of course, they create good entry points when they are swept. So we could look at this kind of conditionally. If we sweep the low, we look for buys towards the high. If we sweep the high, we look for sells towards the low. Okay, because there's that magnet liquidity either side. Now, in examples where we don't have equal highs and equal lows either side of a range, we would simply just use bigger picture market context, okay? So if we created equal lows like this, for example, and we had a demand zone or something here, well, we could look for a pullback, trade through the equal lows, and then trade higher because the overall trend is bullish. So in most cases, we'll be using big picture context, but in some cases where we have clear liquidity ranges with equal highs and equal lows around the range, these become very simple ways for us to trade from one point to the other. All right. So here we would see people buying in. To visualize what most people are looking at here, they will see that reaction and they'll be buying the market, stops beneath the low, especially with what people see as an engulfing pattern. This is a pretty basic confirmation pattern that people use. So that would be a pretty surefire trade that a lot of people will be taking from this point. This, of course, with the stop loss beneath the low, creates a massive amount of liquidity, which is then likely to be taken out. Okay. So if we see what happens next, we get a push beneath, push into those sell stops and stop losses. And can you see here, to highlight what we've been talking about, how aggressive this movement is now? So as we push towards those sell stops and those stop losses, we have a pretty explosive move down, right? This, of course, is an influx of a significant amount of selling pressure being pushed into the market by stop losses being triggered and breakout traders triggering additional sells. And then the absorption that we've been talking about, where the sell orders are getting absorbed by buys. We see here these two large wicks. We see here this additional large wick. And we see this point with a very large candle body, which is closed higher than the previous. This is the absorption we talk about. All of the selling pressure that entered the market around this point has been pushed back upon by buyers, and we've driven up to this point very quickly. Now this is where we lead into an actual tradable opportunity. So if we look at some of the internal structure, okay, at this point we've got these kind of equal highs again. Look at these highs and these highs. Essentially we're looking for the market to break up into the range, okay? So we'll keep these in mind. Given the context we have, this liquidity, equal high, is going to act as a target for price. We see here when the market breaks up, pushes through these internal highs, pushes over these next highs as well. Well, this is the first kind of point where you're going to see each of those concepts that we've talked about in the bootcamp so far coming together. Okay, so here we see a demand zone. Ahead of the demand zone, we see an imbalance, and then we have a break of structure here. So we're seeing structure shifting. Okay, this is internal structure, but it's good for a range-based trade like this, liquidity-based trade. And then we have, of course, the market structure is up, imbalance is open, demand is open, liquidity's been swept, liquidity target on the upside. So you could look at a trade like this, buying from this demand zone with a stop loss under the zone because it's efficient and a target up into the high, right? So that's kind of how you would build a trade out of the information we've got here. Now, if we just play this market forward, you'll see we get a tap in, the market trades into that demand. We no longer have imbalance. We still have maintained bullish structure, and we still have this very clear kind of magnet price target. And as you see, we get a rally straight up into that point, okay? Now, when we hit this high, we didn't create reactions and reverse to the downside, but that is because, and I won't go into it too much, this is actually a bullish structure on the higher time frame, right? So this was coming from a point of interest. Therefore, in a bigger picture, if we considered all context, this could have been used to take the market further, but I wanted to just show you this confined range opportunity that we get between swing highs and swing lows that create equal low and equal high liquidity. So that's an example of, first of all, avoiding bad trades by not buying off of the support, and second of all, identifying that absorption, that structural shift, and catching good opportunities once the market has reversed in your favor with very clear targets, in this case being the equal highs. So that is a full rundown of how this equal high and equal low liquidity looks in real time. So here is another example where equal high and equal low liquidity comes in, but at this time in the context of a clean trending market. All right. So what we've got going on here is a downtrending market. We would ideally in this situation be looking for a continuation. So we want to sell from a supply zone to continue the overall downward direction of the trend. Now, some traders may look at near-term supplies, such as before they were filled, an area like this supply, or as of currently, maybe an area like this supply, right? Given that we've just pushed into a new low. Some traders would look at these opportunities to sell this market down, thinking this will be the continuation point. However, if we just simply look at the highs here, we can see we've got these 1, 2 equal highs, okay? So with the liquidity up here, we've got a pretty good idea that the market is likely to take out these highs because these will be a resistance, and above resistance, we will have liquidity. That liquidity is significant amounts of buy orders. So if we have any institutional participants who want to sell, we are likely to see the market naturally drive up towards this point before we see this kind of flipped, absorbed into sell orders, which should then take the market lower. And this is where those stop loss hunts come in, where people get stopped out trading from support resistance just before the market makes the pure movement. Now, here is an example where we compare equal high liquidity with the other factors that we've looked at in the bootcamp. So obviously, first things first, we've got this downtrend, okay? So we have a structure. Second of all, we have some imbalance above the equal high liquidity. And third of all, we have what we can classify as the extreme supply zone. So we had a supply here, but it was filled by that wick there. Then we created this supply before the imbalance, and this one hasn't yet been filled. So this is a viable supply zone for us to look to sell from. Now, when we see the equal high liquidity, we can use that to filter out this zone as a bad zone, a zone that we wouldn't want to trade from. Because although it is a supply zone and it does have imbalance, it's not one we're going to be interested in given that it's sitting underneath a point of massive liquidity. So what we could do if we were looking for a trade here is wait for these highs to be swept and use this near-term supply zone as our actual execution point where we would place our order. Because if the market can reach into there, that would be the point where it starts to absorb the sell orders and also of course collect new supply from that premium price level, right? So a trade that you could look at from here would be like this, selling supply after liquidity's been taken and trading the market down to make a new low, because of course we're currently in a downtrend. So playing this forward to see how it goes, we come into that first zone. As you can see, we immediately take that out. We see that influx of buying as all these buy orders are triggered into the market. And then as soon as price hits a clear point of kind of premium price, we see a pretty quick sell-off back to the downside, which creates the new low in the trend. All right, so that's what your setup would look like. Now, of course, this one didn't work in the traditional sense of immediately sweep reversing. What it did do, though, is actually combine factors that we've discussed, how we're always looking at market psychology. Now, you may think, well, this didn't work because it didn't immediately reverse from the equal highs. But if we think about the buyer-seller psychology here, this is a point where significant buying is injected into the market, right? So it makes sense that the market runs up because no one executes just here, knowing that the premium price is just above. And when we come into that premium price zone, the supply zone, we then see the influx of selling pressure as people absorb those buying orders and flip them into significant shorts, right? So because that supply zone is there, it's more of a core point for the market to trade into. So sellers allow the buying to take place for a short while, and then the orders go on in mass at this clear premium price point. From there, we see short selling commence and a very, very, very quick drive down because at this point, there's really no resistance from buyers, okay? We've swept liquidity. These people are out. Buyers are no longer interested in getting into a market that is sinking this fast when we see a massive influx of money injected into the market on the short side from this premium price level. So we did two things with this. First of all, we identified this clear supply, the best supply to sell from. And number two, using the liquidity, we filtered out taking a trade from a bad zone. It's a bad zone because, as we said towards the start of the video, never sell below equal highs, never buy above equal lows. That is a classic rule. And because we saw these equal highs, it stopped us from getting in at this zone, which of course would have got us destroyed. Instead, we managed to get in from this zone, and that's where the best trade is going to come from. Okay. So to quickly recap everything we've learned in this class, equal highs and equal lows formulate in the markets under the guise of what a lot of people see as support and resistance levels. Now we derive from these levels, which is a point where 1, 2, 3 or more highs at the same point or lows at the same point have been created. We don't look at them in the standard support and resistance sense, but we look at them as areas where significant buying and selling order pockets are going to be created. Price moves towards orders, it moves towards money, and then it reacts from the points where the most significant amount of orders are. So when we see a point of liquidity like this, we know the market will naturally be drawn to it, and then when we see the market drive into it, we will oftentimes see absorption of the orders and a reversal the other way as institutional or large market participants execute huge counter trades against the liquidity that's just been opened up. Essentially, here we force loads of buy orders into the market, and this allows someone to take the other side and run the market down with uninterrupted force. Equal highs and equal lows can be used, first of all, for filtering out bad zones, so avoiding taking trades from zones like this, and as well as that, taking the best trades by looking at the points of kind of premium or discount price around points of absorption, or just trading directly from sweeps using structure as we did in the previous example. When you understand this, a whole new world opens up in trading. A phrase you'll probably hear, or you may have already heard before, is if you don't see the liquidity, you will be the liquidity. And hopefully now you understand how true that is. Because if you are not understanding this concept and you're not utilizing it in your trading, well, you're going to be the person getting snapped up in the fake zones like this and getting caught in those traps. Now you've watched this class, you don't have to. So the next few classes are going to be focused on liquidity as well in different formats. You'll use those ones a little bit less, but they are incredibly valuable to know and understand. And with that, I look forward to seeing you in the next episode. In the meantime, head to the link in the description and watch that 15-minute trading diagnosis class. That's going to change the way that you operate behind the scenes, the things that you can't fix with the chart. So definitely check that out, and I'll see you in the next Bootcamp episode.